Welcome back to the Technology Risk Podcast. We know your time is valuable, so before we get started with today's breakdown, if you could just take a second to subscribe on Spotify, Apple Podcasts, YouTube Music, Recording, wherever you get your podcasts. It really helps, and it means you'll never miss our analysis. So our focus today is really for you. If you're a manager, a CTO, a business owner, wrestling with, I think one of the biggest questions right now is all this money we're pouring into AI.
Yeah.
Is it actually paying off?
Yeah. Is there a real return?
Exactly. And we're going to zero in on a pretty uncomfortable earnings surprise from a huge legacy player, Oracle. This wasn't just a blip. It felt like a crack in the whole AI growth story.
It absolutely was. And we need to understand what that means for vendor trust, for ROI risk, particularly if you're a small or mid-sized business.
Okay, let's unpack that then. The date was December 11, 2025. Oracle reports and the market reaction.
Yeah.
It was sharp.
It was immediate. And this wasn't just a routine, oh, we missed by a little bit. This one triggered some really fundamental questions about the actual economics of AI. I mean, if a giant like Oracle, with all its resources, struggles to turn billions in AI spending into predictable value.
And what hope does anyone else have? It puts every single cloud contract you might be thinking of signing right under the microscope.
Exactly. So today we're going to look at what this really signals about AI economics. We'll talk about why this kind of vendor risk is so much more dangerous for SMBs. And then most importantly, we'll get into some real guidance on how you can evaluate and, future-proof your own commitments in this market.
It's so important because the narrative for years has just been one of guaranteed growth. AI was supposed to be this, magic bullet.
Inevitable and urgent, that was the phrase.
Right. But Oracle's results just pulled back the curtain on a very difficult truth. Scaling up your AI capability doesn't guarantee profit. In fact, it might just guarantee a massive bill.
A huge one.
And the numbers really show this disconnect, don't they? We pulled this from the research. Global enterprise AI infrastructure spending is up over 40% year over year. I mean, that's just a breathtaking amount of money.
It's huge, but then you put it next to the other number.
The McKinsey research. Only 32% of companies are reporting any measurable ROI from that spending.
So you have a two-thirds gap. Two-thirds of companies are spending big and getting, buyer's remorse, basically?
So what's so fascinating here is digging into why. Why isn't that ROI showing up, even for the vendors themselves?
Well, AI infrastructure is just incredibly capital intensive. It's risky. Oracle is playing this very aggressive game of catch up with the big hyperscalers, AWS, Azure, Google.
And to compete, you have to spend.
You have to spend billions on data centers, on the latest GPUs, on building out this massive AI cloud capacity. And here's the real structural problem. Those data center buildouts. They now account for over 60% of a vendor's capital expenditure, their CapEx.
Over 60%.
And that is just crushing their margins, even for these massive providers. It creates this immense pressure.
Pressure to get that money back.
Immediately, which leads to rigid, long-term contracts and prioritizing only the biggest, whale-sized deals. And it completely changes that narrative we talked about.
Right. How can you, as a smaller business, trust the urgency of adopting AI when the vendor's own financials don't even back up the hype?
You can't. That's the problem. When a major vendor is struggling like that, it creates a pattern of behavior, and that pattern flows directly downhill.
And the SMB is sitting at the bottom of that hill.
Always.
Okay, so let's pivot to that. What does all this volatility mean for you, the small or mid-sized business owner? You don't have Oracle's balance sheet to absorb these kinds of sunk costs.
No war chest. No.
So when an AI project goes sideways, that misjudged investment, it's not just a line item. It becomes what we call a budget black hole.
I like that term. It just sucks everything else in.
It does. It crowds out core operations, hiring people you actually need, other innovation. And there's a statistic on this that it floored me from Flexra.
I think I know the one you mean.
A staggering 46% of SMBs say they regret at least one cloud or AI contract they've signed in the last 3 years.
Almost half. That is an abstract regret. That's real money, real pain. It comes from being locked into a long-term deal that just isn't delivering short-term value.
So why is that regret rate so high? What's the core issue?
I think it's because AI is often marketed like it's just software, plug and play. But the reality is it's so much harder. AI deployment does not equal immediate value.
Right. It needs so much prep work.
A massive amount. You need clean data, you need to rebuild processes, you have to train your people, and then there's the constant oversight and tuning. You're not just buying a license.
You're buying a project that requires you to build a whole house around it.
Yeah, an expensive house. And this is where those hidden costs just multiply. You sign the software license, and that looks manageable, but then the bills start to come in for the cloud compute to actually run the models.
The storage for the data, the integration time with your other systems, the security.
And the ongoing tuning. It never stops.
That distinction is so critical. I saw some Gartner research that quantified this perfectly. For every $1 you spend on the AI software license, companies spend $3 to $5 on all those other indirect hidden costs.
And for a smaller budget, that's absolutely crushing. You thought you were spending $100,000, and suddenly you're looking at a $500,000 bill for things you never even saw coming.
And the long-term contracts, they just make it all worse.
They're a trap. The vendor offers you a 20% discount for a 5-year commitment. It looks great. But if that ROI doesn't show up in 6 months, you're still on the hook for 4.5 more years.
You're stuck.
Completely. And that's why flexibility right now is so much more valuable than a small discount. Once your data and your workflows are in their system, the switching costs are so high that you lose all your leverage. You're basically chin to them.
The Oracle situation really proves it then. Size doesn't equal certainty. These big AI bets can fail, even at a billion-dollar scale. And that means vendor stability itself.
Yeah.
It's now a core risk factor.
Absolutely. And when a vendor misses its earnings, especially for this reason, they have to respond. They cut costs, they reprioritize. And you, the SMB, you're the first to feel that.
The degradation in service.
Instantly. Think about that great account manager who sold you the dream, the one who promised you everything.
That person is often one of the first to go into restructuring.
Yep. And your relationship immediately becomes a faceless ticketing system, and that's just the start.
Because then it hits the product itself. The roadmap you were promised gets delayed.
Indefinitely. Or features get rebranded as future projects. Pricing models suddenly shift. Support tiers just quietly shrink.
And the core problem for SMBs here is leverage, right? When a vendor is trying to stabilize, they focus on the enterprise clients spending millions.
Of course. That's how they save their quarter. The SMBs get left with longer wait times, fewer concessions. They have almost no voice. So that idea of blind trust, it's just not a viable strategy anymore.
Okay, so given this new world of risk and volatility, you don't have to avoid AI completely.
No, not at all. But you have to be disciplined. You have to be skeptical.
So we've synthesized this down into 5, let's call them non-negotiable steps for future-proofing your investments.
Right. Let's start with the first one, which is all about clarity.
Step 1, demand clear, measurable ROI definitions. This sounds obvious, but it's amazing how often it's skipped.
You have to push past the marketing jargon. If they say efficiency, you have to push back and ask, what does that actually mean? Does that mean 15% fewer support tickets? Does it mean 10% faster processing time?
How will we know, specifically, if this worked in 6 months or in 2 years, if they can't give you a hard metric tied to revenue, cost, or risk?
You walk away. Simple as that. Which brings us to step 2. Avoid long-term commitments up front.
The 5-year discount is a siren song.
It's a trap. You have to insist on a pilot program, 6 months maximum, with hard cost caps and a very clear opt-out clause. You should only pay for proven value, not for their optimism.
Okay, next up, proving that value. Step 3 is to rigorously separate the capability from the hype.
Right. Before you sign anything, you have to force them to answer one of 3 questions. Does this tool improve our revenue? Does it reduce our operational cost? Or does it mitigate a specific risk?
And if the only answer is, well, it looks impressive or it's future-proof.
That's hype, and you shouldn't be paying for hype.
Okay, step 4, stress test vendor stability. This feels new. We used to just assume the big guys were stable.
We did, but not anymore. You need to act like a skeptical financial analyst. Read their last few earnings reports. Look for code words like restructuring or workforce optimization.
Which just means layoffs are coming.
Exactly. Layoffs that will hit your support quality. Check for executive churn. Look at their roadmap. Has it been consistent? You have to do this due diligence now.
And finally, the most important one to avoid getting trapped. Step 5, plan for exit before you enter.
This is critical. You have to understand how you get your data out. Not just that you can, but how. How is it extracted? How is it transformed into a usable format for a competitor?
Because getting data out of a proprietary AI stack is not a simple download.
Not at all. It's complex, it's time-consuming, and it's expensive. You need to negotiate the fixed, transparent cost for that extraction right at the beginning, in the contract. Your flexibility is your best defense.
Let's make this real. You have a story about a firm that got this wrong.
Yeah, mid-size engineering firm. They signed a 5-year deal for AI automation and procurement. They committed blindly. The tool ended up needing so much manual data scrubbing that it wiped out any savings.
And then the vendor restructured.
Their support vanished. And they were left paying millions for a useless system, a total budget black hole.
But contrast that with a success story. A different SMB, piloting an AI forecasting tool.
Right. They insisted on a 6-month pilot with cost caps. They saw the value, but when the vendor pushed for a long-term deal, they held firm and negotiated a 1-year rolling contract.
So they got the benefit without the risk.
Exactly. Controlled experimentation and contractual optionality. It beats blind commitment every single time.
So when we pull this all together, what does it all mean for you today? Oracle's experience, it really just highlights a deeper truth, doesn't it?
It does. That AI infrastructure spending, even in the billions, does not automatically translate into ROI, not even for the giants.
So we'd really encourage you to go back and review your current AI and cloud contracts right now.
And challenge every single ROI assumption. Make sure you are not locked into something that could become a problem down the road. You have to treat your AI adoption like a risk portfolio.
Spread your bets, limit your exposure with short-term deals.
And reassess the value you're getting constantly. When the vendors themselves are struggling to make AI pay off, blind trust is no longer a strategy.
Healthy skepticism and flexibility. They're not optional anymore. They are absolutely essential for survival.
Thank you for joining us for this analysis on the Technology Risk Podcast. If you found this breakdown valuable, please take a moment to subscribe. We're on Spotify, Apple Podcasts, YouTube Music, and all the major platforms. We'll be back soon with more insights.